Daily Cycles here with a weekend video on the last day of November. So it looks pretty much like the S&P has ruined the bearish setup, and we are still following the 1980 scenario very closely here. So, as you see, the 1980s scenario did go sideways here for a while before the downtrend really began. And up here you see the 17-week cycle, the tops, and time is running out to make this a bearish 17-week cycle, and we have the holidays coming up, so it looks less and less likely that we will have anything very bearish going on here before or just before Christmas or in January. And it looks more likely we will have to make a topping formation into around February. We have, here's Bitcoin. Bitcoin is following the 4-week cycle very nicely, and we are seeing the bounce I was expecting, and now around this coming week we could, or we should, roll over to get the last leg down of this correction. It could be a double low or a lower low or something like that. Some kind of a bottom formation is possible, and then we could see a rally into February, into the next 17-week cycle top. We also did get a bounce in the S&P, but much stronger than expected, while the bounce in Bitcoin is kind of weaker than expected. Here is Bitcoin comparing with the two previous cycles, going back one cycle, two cycles, and comparing. We see at this point, Bitcoin was starting to break down, but this coming week it's still room for a little bit more bounce or going sideways before we turn down into this low, which should be around mid, let's see, that's around December the 17th, looks like. And we are kind of following the pattern from these typical corrections that we have seen the recent couple of years. The average of these is making a low around mid-December. So Bitcoin is again easier to predict, while the S&P is behaving more bullish. As you see, the S&P here in green is also following the 4-week cycle with a low, kind of a low here and here and here and this one, while this low was a bit distorted, and then we got a low at this 4-week cycle low, and currently, this coming week we could start rollover, and let's have a deeper look at the S&P, because the 10-week cycle is behaving a bit strange here. So my primitive tool for spotting a correction low is market is just bouncing up earlier than expected. This is something you can see in the middle of a bull market, but this should be a bull market topping out. So so the bearish scenario here is pretty much gone, but this could be some more sideways action here. So let's switch to have some other analogs here, because here are the number of days above the 50-day moving average, and this run we just had is in the top 1, 2, 3, 4, in the top 5 for the last 70 or 80 years. So pretty extreme. And if you compare with some of these long runs, you see what happens after finally breaking the 50-day moving average? Well, some of these analogs, they dropped further down the next few days, just like we did here in orange, and then abruptly rallying up to a double top or a higher high or something like that. And then it's more indecisive here. Some of these just then collapsed right down again. And we have some variation. Like this 2018, it was not the final high of the bull market, and 1989 was neither. So these two were more bearish. 2011, 1983, and both of these, again, we see they suggest a sideways action into the winter before we really roll over. So yeah, we could just crash down and get some kind of sideways correction into mid-December, or we could see some kind of a struggling uptrend into January, February. Well, I really don't know this time. We have VIX. The VIX wavelet is just very confused here. It has turned up again, and the wavelet for VIX and S&P are a bit out of phase. It's very unusual. It looks like a very confused market. At least my indicators get very confused. But the average of these is suggesting, we have made a 10-week oscillation low, and now we are beginning a new one. But there's something, this stinks a bit, because this is much too short for a 10-week oscillation. If we look at, here, we had a 10-week oscillation low in April, and then we had one here in June, and this one is a bit hard to identify, and then we have this one in October, and as you see, the length of this first one is pretty normal. The second one is 8 weeks. That's about the minimum of a 10-week oscillation. It should not be shorter than 8 weeks. And this next one is also around 8 weeks. So we have two that are very short. And then we have this one. If this is a 10-week oscillation low, it's just around 6 weeks. No, that's too short. There's something wrong here. So I wouldn't trust this to be over. But if we went down to make some kind of a low, a double low, or almost a double low in mid-December, then it could look like a completed 10-week oscillation, and we could look out for a next high in February. So let me see, we have the hourly data for Dow Jones Industrial, and here we have the 2-week oscillation, and currently, we bounced up from this 2-week oscillation low, and now we are going past the midpoint, so we only have about 3 or 4 days with bearish bias, and then it's bullish again. So no, this is not looking very bearish. And then we have the first few days of a new month on Monday, December the 1st. That's always bullish. So and summing up, we pretty much erased all the overbought indicators with this correction, but there are still quite a few indicators saying, that was a nice correction, but it was not enough to erase all the overbought indicators, suggesting that the market is not ready to rally. We need to go more sideways or down before we could make an attempt for a real new all-time high in February. So in summing up, I don't think it's time for any rally to all-time high. We need to go more sideways, and probably sideways into February before we get a really bearish setup. Bye bye.